If you own XEQT or VEQT, you already own emerging markets. About 12 cents of every dollar you have invested is sitting in companies based in China, India, Taiwan, Brazil, Saudi Arabia, and about 20 other developing economies around the world. Most people who own XEQT have never thought about that 12 cents. They do not know what is in it, whether it is the right amount, or what it would mean to have more or less. This video covers the complete emerging markets conversation for Canadian investors. What emerging markets actually are. What is already in your XEQT. The three specific ETFs, VEE, XEC, and VXUS, and which one makes sense depending on what you are trying to do. And the one structural difference between VEE and XEC that almost nobody explains, involving South Korea, that determines which ETF is actually compatible with the index your all-in-one ETF already uses. What emerging markets actually are, and why they are in your portfolio. Emerging markets is the term used to describe economies that are developing, growing faster than established Western economies, with expanding middle classes, rising consumer spending, and increasingly sophisticated financial markets, but that carry higher political, regulatory, and currency risk than developed markets like the US, Canada, Germany, or Japan. The current major emerging markets in a typical ETF, China, Taiwan, India, South Korea, depending on the index, Brazil, Saudi Arabia, South Africa, Thailand, Mexico, Indonesia, Malaysia. They represent economies at different stages of development with very different risk profiles, but they are grouped together because they share characteristics of higher growth potential and higher volatility relative to developed market peers. Here is the fundamental argument for including emerging markets in a portfolio. The world's emerging economies contain approximately 85% of the global population and produce approximately 60% of global GDP measured at purchasing power parity. But emerging markets represent only approximately 12% to 15% of global equity market capitalization. The gap between their economic weight and their stock market weight represents the opportunity argument. These economies are growing faster but are proportionally less represented in global equity indices than their economic size would suggest. The counter-argument is equally real. Emerging markets carry meaningful risks that developed markets do not. Political risk. Governments in emerging markets can nationalize industries, change regulations abruptly, restrict foreign ownership, or simply be unstable. Currency risk. A Brazilian company reporting in Brazilian reais, an Indian company in rupees. Currency movements add a layer of volatility beyond the underlying business performance. Regulatory risk. Chinese technology companies experienced significant government intervention in 2021 and 2022 that cost investors significant capital. Accounting and transparency standards vary significantly from country to country. The honest position, emerging markets belong in a diversified global portfolio, which is why XEQT and VEQT include them. The question is not whether to have any exposure, but whether the built-in allocation is appropriate or whether you want more. The vault. The South Korea problem nobody explains. Here is the vault. The one structural difference between VEE and XEC that almost nobody explains before recommending one over the other, and that has meaningful consequences for anyone who already owns XEQT or VEQT. The question, is South Korea an emerging market or a developed market? The answer depends entirely on which index provider you ask. MSCI, the index provider behind XEC, classifies South Korea as an emerging market. South Korea represents approximately 13% of XEC, Its major holdings through this classification: Samsung Electronics, SK Hynix, LG Electronics, Hyundai Motor Group. MSCI has been considering upgrading South Korea to developed market status for years. But as of 2026, it remains in the Emerging Markets Index. FTSE, the index provider behind VEE and behind XEQT, classifies South Korea as a developed market. South Korea is not in FTSE's Emerging Markets Index at all. It appears in FTSE's Developed Markets Index, which means it is in the International Developed sleeve of XEQT, not the Emerging Markets sleeve. Why does this matter for Canadian investors? If you own XEQT, which uses FTSE, and you add VEE, which also uses FTSE, the classifications are consistent. Your Korea exposure sits in XEQT's developed slice, and VEE adds no Korea at all. Clean. If you own XEQT, which uses FTSE, and you add XEC, which uses MSCI, South Korea appears in two places simultaneously. Once in XEQT's developed markets sleeve as a developed market. Once in XEC's emerging markets sleeve as an emerging market. You have unintentionally doubled your South Korea exposure without making any decision to do so. This is not catastrophic. South Korea is a good market. Samsung is an excellent company. But if you are choosing to add emerging markets exposure specifically because you want more China, India, or Brazil, and you accidentally also doubled your Samsung and SK Hynix exposure, that is worth knowing before you buy. The practical implication for XEQT and VEQT holders adding emerging markets exposure, VEE is the cleaner choice because both use FTSE classifications. XEC is a legitimate ETF with $3.67 billion in Canadian assets. It is just that the South Korea inclusion creates an unintentional overlap with the developed market sleeve of any FTSE-indexed all-in-one ETF. VEE versus XEC, the side-by-side. With the South Korea context clear, the rest of the VEE versus XEC comparison. Holdings: VEE holds approximately 5,000 to 5,446 stocks, including large, mid, and small-cap companies across emerging markets. XEC holds approximately 2,581 stocks, large and mid-cap only, no small-cap. For investors who believe small-cap emerging market companies carry meaningful long-term growth potential, VEE's broader coverage is advantageous. For investors who want the most liquid, well-established emerging market companies, XEC's focus is appropriate. Geography. Both are dominated by China, Taiwan, and India. VEE's China weight is approximately 32% versus XEC's 27%. VEE's India weight is approximately 16% versus XEC's 14%. The difference is largely the South Korea inclusion in XEC, approximately 13%, which displaces other country weights. Cost: VE charges 0.24%, XEC charges 0.26% to 0.28%. On $100,000 invested over 20 years at 7% gross return. The fee difference between VEE and XEC produces approximately $2,763 more in VEE's favor. Not dramatic, but VE wins on cost. Performance. Both track their respective indices closely. The performance difference between the two ETFs over most long periods is driven more by the South Korea inclusion in XEC than by any other factor. In years when South Korean equities outperform broader emerging markets, XEC benefits. In years when they underperform, XEC suffers relative to VEE. AUM XEEC has $3.67 billion in Canadian AUM, significantly larger and more liquid than VEE, both are well above the threshold where liquidity becomes a practical concern for retail investors. The verdict for most XEQT holders: VEE cheaper, more holdings, no index mismatch with FTSE-based all-in-ones, cleaner emerging markets exposure without the South Korea overlap. VXUS, the complete XUS solution. VXUS is different from VEE and XEC in a fundamental way that needs to be stated clearly before anything else. VXUS is not an emerging markets-only ETF. It is the Vanguard Total International Stock ETF. It covers the entire world outside the United States, developed markets and emerging markets together. Europe, Japan, Australia, Canada, the UK, emerging markets, everything except U.S. equities. It holds approximately 8,500 stocks. Approximately 75% to 80% of the fund is in developed markets. Approximately 20% to 25% is in emerging markets. The top holdings include not just TSMC and Tencent, but also Nestlé, ASML, AstraZeneca, Novartis, and Samsung. The expense ratio, 0.05%. That is $5 per year on every $10,000 invested. For a fund covering the entire world outside the U.S., that is an extraordinary cost structure. $158 billion in assets under management. One of the largest international ETFs in the world. YTD 2026, plus 17.20%. 12-month return through March 2026, plus 25.47%. Morningstar, 4 stars in the foreign large blend category across 651 comparable funds. Who is VXUS for? VXUS is specifically interesting for Canadian investors who are building a custom portfolio, not using an all-in-one like XEQT, and want the complete international sleeve in a single U.S.-listed ETF at the lowest possible cost. Instead of XEQT's built-in international exposure, an investor might hold VFV for U.S. exposure, VCN for Canadian exposure, and VXUS for everything else. The 3 ETF portfolio, VFV plus VCN plus VXUS, covers the entire global equity market at very low cost. It is U.S. listed, purchased in U.S. dollars, which means currency conversion is required. Norbert's Gambit is the standard approach for Canadian investors to convert Canadian dollars to U.S. dollars without paying the bank's 1.5% to 2.5% currency spread. The RRSP provides some treaty benefit on the portion of income derived from U.S.-related sources within the fund. Why not just use XEQT? For most Canadians, XEQT is simpler and the right answer. But for investors who want more precise control over their geographic allocations, the custom 3 ETF approach with VXUS gives you the ability to tilt more or less Canada, more or less US, more or less international, while keeping costs extremely low. VXUS at 0.05% is cheaper than the international component of any Canadian all-in-one ETF. Should you add more emerging markets? The honest answer: if you own XEQT or VEQT, you have approximately 12% in emerging markets already. The question of whether to add more is genuinely a personal decision, not a universal recommendation. Here is the honest framework. Reasons to add more. You believe the structural case, that economies representing 85% of the world's population and 60% of global GDP will see their equity markets catch up to their economic weight over your investment horizon. You have a long time horizon, 15 or more years, that allows you to absorb the higher volatility that emerging markets carry. You are comfortable with China-specific risk, which is the largest single country weight in any emerging market ETF, and carries meaningful political and regulatory uncertainty. Reasons to stay with the 12% built into XEQT. The built-in allocation is already globally diversified. The complexity of managing a separate emerging markets sleeve adds tracking requirements, potential rebalancing decisions, and the South Korea classification issue outlined above. Emerging markets have historically underperformed developed markets over many 10 to 20-year periods. The growth story has not reliably translated into equity returns in the way the economic growth data might suggest. The additional risk is real, and the additional reward is not guaranteed. The specific scenario where adding VEE makes sense. An investor who has been holding XEQT for 5 or more years, has a long remaining horizon, is comfortable with the China and India exposure, wants to increase the international weighting of the portfolio away from U.S. concentration, and understands the higher volatility they are accepting. Adding VEE to XEQT increases the emerging markets weighting from approximately 12% to whatever the combined allocation produces, and does so using the consistent FTSE index methodology that avoids the South Korea double count. The amount, typically 5% to 15% of a portfolio in a dedicated emerging markets sleeve on top of XEQT, is the range where the exposure is meaningful without being dominant. The emerging markets conversation is more nuanced than most ETF content suggests. Here is the complete picture. You already have emerging markets. About 12% of XEQT or VEQT is in China, India, Taiwan, Brazil, and about 20 other developing economies. Before making any decision, know what you already own. If you want to add more, VEE is the cleaner choice for XEQT and VEQT holders because both use FTSE indices. XEC uses MSCI, which classifies South Korea differently, creating an unintentional overlap with your all-in-one ETF's developed market sleeve. Neither is wrong, but the index consistency matters. If you want the complete international picture, in one U.S.-listed ETF, VXUS covers the entire world outside the U.S. at 0.05% expense ratio. It is not an emerging markets ETF. It is the complete ex-US solution for investors building a custom 3 ETF portfolio. And the most important honest point, emerging market GDP growth does not automatically translate into equity returns. The economic case for emerging markets is compelling. The historical equity return case is more mixed. Know both before you decide.